Hi, everybody. This is Peter Schiff. Last week, President Obama finally made it official and nominated Janet Yellen to chair the Federal Reserve Board. For a while, though, of course, there was a lot of speculation as to exactly who the president was going to pick. From the beginning, though, my money was always on Yellen. And the reason I was so confident that the president would choose Yellen was because I believed of all the candidates in serious consideration, Yellen was by far the worst choice. And I was very confident that President Obama would make the worst choice, and he didn't disappoint me. That is precisely what he did. Now, if you listen to the media and how they're reacting to the Yellen nomination, you would think that Janet Yellen, is the greatest economic forecaster of our time. They're portraying Yellen as if she was some lone voice crying out, there's a housing bubble, and nobody would listen. She was sounding the alarm, and her cries were falling on the deaf ears of her colleagues. Have a listen. I'm going to read what some of the reporters are writing about Janet Yellen. This is from the New York Times. It's an op-ed submitted by the editorial board of the New York Times, October 9th. Quote, as president of the Federal Reserve Bank of San Francisco from 2004 to 2010, Janet Yellen sounded the warning about the housing bubbles, even as others praised the boom. Here's what Alan Blinder wrote in the Wall Street Journal. Yellen was one of the first members of the Federal Open Market Committee to realize the housing market's troubles could cause a major recession. Ed Harris, writing in the New York Times, Janet Yellen was one of the only top Fed policymakers who warned about the housing bubble before the crisis. Matthew O'Brien in The Atlantic, quote, Janet Yellen raised concerns about the housing bubble in the mid-2000s and highlighted the dangers of a credit crunch. Here, Mark Gungloff, writing for the Huffington Post, Janet Yellen warned early and often, starting at least in 2005, about the problems in housing and the looming economic catastrophe. And finally, in a letter written to President Obama and signed by about a third of the Senate Democrats urging the nomination of Janet Yellen, they wrote, quote, she displayed prescience and identified the impending threats that both the housing bubble and the shadow banking sector pose to our entire economy. So there you have it. She was Cassandra. She was sounding the alarm. She knew a huge crisis was coming, yet nobody listened to her. The implications being that if Janet Yellen had only been Fed chairman instead of just one of the governors, we wouldn't have had a housing bubble, or maybe the bubble would have been much smaller, the fallout not nearly as great had she been on the helm. But now we have an opportunity to really nominate a Fed chairman that has a great understanding of economics and is an excellent forecaster, because after all, she tried to warn us about the huge dangers of this massive housing bubble. She was worried about a huge financial crisis, and nobody listened to her. None of that is true. It is complete, unadulterated nonsense. It is entirely made up. In fact, not only does the record not support that she warned about anything, but it actually shows that she downplayed the warnings that were made by others. She was reassuring everybody that there was nothing to worry about when it came to the housing bubble. So all of this is being made up. But don't take my word for it. Let's listen to what Janet Yellen said herself. I'm going to go back to the very speeches that the media is relying on as evidence that she saw the crisis coming and warned about it. Because, most people, they're not going to read the speeches that everybody is referencing. They're just going to assume that the references are correct, but they're not. They're completely fabricated. So I'm going to go back. These are the exact speeches, the two speeches, one in '05 and one in '06, that everybody is using as evidence to support the idea that Janet Yellen warned about the housing bubble. First, this is from the 4th annual Haas Gala, Haas Business School in Berkeley, my old alma mater. This is from San Francisco, October 24th, 2005. I'm going to read what Janet Yellen said in that speech. And of course, these speeches are on the internet. So if you think I'm making any of it up, you can Google the stuff yourself. Here it is. Quote, today, it's not stock prices, but house prices that have been soaring. Soaring house prices have raised concerns about national economic stability. Note she says that there have been concerns raised. She doesn't specify that she's concerned. She just says that there are concerns out there. Let me go back. In the U.S. as a whole, the share of residential investment in GDP is now at its highest level in decades, and this sector has been a key source of strength in the current expansion. So she doesn't necessarily see it as a problem. She sees it as a source of strength. I'll continue. The question for policy is, will this source of strength reverse course and become instead a source of weakness? Question mark. It's a question. It's not a statement. Put more bluntly, is there a house price bubble that might deflate? And if so, what would that mean for the national economy? So she's not saying there is a housing bubble that will deflate. She is posting a question. Is there a bubble? And if there is a bubble, should it be a problem? What might happen if it deflates? So this is not somebody that's warning about anything. She is discussing an issue. Now, she starts to talk about a bubble. Quote, the literature generally defines a bubble as a situation where the price of an asset, in this case housing, is significantly higher than its fundamental value. One common way of judging whether housing's price is in line with its fundamental value is to consider the ratio of house prices to rents. Currently, the ratio for the U.S. is higher than at any time since the data became available in 1970, about 38% above its long-run average. So in trying to make the case for a bubble, she can point to one possible indication of a bubble, which is price to rents. That's all she can come up with. In the entire speech, the only evidence that she has for the potential of a bubble is that one data point. There's nothing else. Now she begins to talk about why there might not be a bubble. She says, quote, higher than normal ratios do not necessarily prove that there's a housing price bubble. Of course, there was a lot of other proof that she was blind to, but let's get back to what she said. Quote, house prices could be high for some good fundamental reasons. For example, changes in the tax laws that reduce the potential tax bite from selling one's home and buying another. Innovations in the mortgage markets make the funds invested in housing more liquid. Constraints on the supply of housing in a number of markets. And the most fundamental factor, low mortgage interest rates. So she goes on the list 4 fundamental reasons to validate the increase in home prices, suggesting that it's not a bubble. And of course, she's talking about the mortgage market, home equity extractions, all the problems that are in the credit market. She identifies as pluses, as reasons why housing is not in a bubble. Now I'm going to continue. So while I'm certainly not predicting anything about the future house price movements, so here you go. I mean, obviously she's not warning about a housing price collapse when she says flat out she's not making any predictions at all about the housing market. I think it's obvious that the housing sector represents a serious issue for monetary policy makers to consider. Okay, housing is a serious issue to consider. It's not a threat. She has no idea what's going to happen to housing prices. She doesn't think it's a bubble. She acknowledges that housing is a serious issue that we ought to consider, but that's it. I mean, that's the closest thing to a warning she ever gave in 2005 or 2006 for that matter, and it doesn't constitute as a warning. Now, let me continue. She says, how should monetary policy react to unusually high prices of houses or other assets for that matter? In my view, it makes sense to organize one's thinking around 3 consecutive questions, 3 hurdles to jump before pulling the monetary policy trigger. First, if the bubble were to deflate on its own, would the effect on the economy be exceedingly large? Second, is it unlikely that the Fed could mitigate the consequences? And third, is monetary policy the best tool to use to deflate a house price bubble? My answer to these questions in the shortest possible form are no, no, and no. Right? So in other words, if there's a housing bubble, which she doesn't concede that there is, but if there is one and it bursts, according to Yellen, it's no big deal. it's not going to have a big effect on the economy. Here in her own words, in answer to the first question on the size of the effect, this is the effect of the bursting of the housing bubble, which she doesn't even believe exists. It could be large enough, not will be, it could be large enough to feel like a good-sized bump in the road. But the economy would likely be able to absorb the shock. Oh yeah, sounds like a big warning to me. She's really worried about what might happen if the housing bubble bursts. Yeah, it's going to be a bump in the road. That's it. In answer to the second question on timing, the spending slowdown that would ensue is likely to kick in gradually because it mainly affects household wealth. So the impact of a gradual spending slowdown could be well cushioned by an easier policy. So in other words, she's not worried at all, and she's not recommending anything different at the Fed than what is already going on. Here's the rest of it. Quote, taking all these points into consideration, it seems that the arguments against trying to deflate a bubble outweigh those in favor of it. So even if there is a bubble, she's saying the Fed should do nothing to try to deflate it because even if it bursts, it's no big deal. But of course, she doesn't believe there's a bubble. She poses the question at the beginning of her speech, is there a bubble? And based on the speech, you have to conclude that her answer is no. She thinks there are people that think there might be a bubble based on evidence, and the only evidence she can point to is rents. But then she comes up with all these fundamental examples of why she believes that the housing prices are justified by the fundamentals. Now, that's the 2005 speech. When everybody says she started warning as early as 2005, they're basing that on that speech. But she didn't warn about anything. All she really did is try to downplay the risks. She tried to dismiss the warnings that others were making and say there's nothing to worry about. The housing market is fine. The economy is fine. And she reiterates that in her 2006 speech. This is a presentation to the Bay Area Council Outlook Conference in 2006, April of 2006. Let me read what Janet Yellen said in that speech. Quote, I'll start with the broad brushstrokes on the outlook for economic activity. Prospects for growth in the year ahead are solid at the national level. The U.S. economy has shown remarkable resilience in the face of some severe shocks. Economic growth appears to have roared back in the first quarter of this year. My best guess is that economic activity will remain healthy, supported by strong productivity growth and continued strength in consumer spending and business investment. I expect economic activity to settle back to more trend-like and sustainable rates as the year progresses. This is April 2006. Does this sound like somebody who is warning about a major recession, about a housing bubble that's about to burst, about a financial crisis? She's very optimistic in April 2006. Now, here's where she talks a little bit about housing. A significant moderation in the rate of appreciation of house prices could well restrict not only the pace of residential construction, but also the pace of consumer spending. So she is forecasting the possibility. She's not saying it will happen for sure. The possibility that the rate of appreciation in home prices might slow down. She's not talking about real estate prices going down. She's saying that maybe they won't go up as fast as they have. That's all she's thinking about. Let me continue. Some observers, right, not her, right, some observers, she's not saying me, some observers believe that consumer spending has been bolstered by the withdrawal of equity from housing. Well, of course it has. And of course, this source of funds would be smaller if the pace of appreciation abated. Again, she's talking about houses appreciating more slowly, right? Not a bubble bursting. Furthermore, there is the so-called wealth effect. Now, maybe she's saying so-called because she doesn't actually believe it exists because it was real, right? There's the so-called wealth effect on spending because houses are such an important part of many people's portfolios of assets. With this asset appreciating more slowly, consumers are likely to pull back in spending. So again, she is postulating that going forward, houses might not be rising as fast in price as they were in the past. And it's possible, not definite. It's possible because some people are worried about a wealth effect. Some people think that housing has been an important component in consumer spending. Not necessarily Janet Yellen, but other people. And maybe if they're right, well, maybe it could be a slight drag, but she's still very optimistic on the economy. Now, listen to this. Here is where Janet Yellen, for the first time, entertains the possibility that real estate prices might actually fall. Listen to what she said. First, house prices could surprise us in either direction. In other words, instead of the significant moderation I've built into my forecast, home price appreciation could either slow much more than I expect, or it could continue at its current pace. In other words, she anticipates real estate prices to keep rising, just not as quickly as they were rising before, but you could be wrong. They might rise even more slowly than she thinks, or they might continue to rise at the same pace. Now, she postulates something different. If it slows much faster, or worse yet, reverses course. That's it, reverses course. That means goes down. The impact could be very restrictive for both residential construction and consumer spending. That's it. That is the entirety of her warning. That maybe if real estate prices were to fall, which is something that she does not expect, that it could be restrictive to residential construction and consumer spending. Not that it will be, but that it might be. And again, she limits her concern to one part of the economy. She doesn't say it could usher in a financial crisis, a great recession. We need to do something to guard against this possibility. No, she's quite sanguine. If she's wrong and real estate prices don't keep rising, if instead they go down, it's possible that it could be a slight negative because it might be restrictive for residential construction and consumer spending. Now, let me continue. Alternatively, house prices might go on climbing as fast as ever. So she's really going on the limb here. She really knows what's going on. They may keep going up. They may go up faster than she thinks. They may go up more slowly. They may go up even faster than ever. Maybe it's possible they might go down. That's it. That is the sum total of her warning. In fact, she continues, she says, so far, the early signs of cooling in U.S. housing markets are broadly consistent with the degree of moderation I've envisioned. In other words, everything is fine. She thinks her forecast of a moderation in the appreciation of home prices is right on schedule. Everything is fine. There's nothing wrong with the economy. There's nothing wrong with the housing market. There are no threats, according to Janet Yellen. Yet the media is basing this. They're basing this speech and saying she was warning about a housing bubble. How could she have been warning about a bubble if she expected the prices to keep going up? If you think it's a bubble, you think the prices are too high, and you would think they were going to come down. But not Janet Yellen. And she couldn't even see the housing bubble after it had peaked because the peak was in '05. It's already started to deflate, and she still doesn't know it's there. Now, here is a quote I've got from the Fed minutes from the meeting in September of 2006. Housing prices are now falling, which is something that Janet Yellen did not see coming. And here is her admission of that fact. Quote, the speed of the fall off in housing activity and the deceleration in house prices continues to surprise us, including Janet Yellen. She's part of us. So now she's acknowledging that housing prices have gone down, which was a surprise to her because she expected them to go up. And instead, they went down. But now she's assuring everybody not to worry. Listen to what she said after she acknowledged a surprise drop in home prices. Quote, of course, housing is a relatively small sector of the economy and its decline should be self-correcting. So now she admits that housing prices are falling, but she's telling everybody not to worry. It's no big deal. Housing is a small part of the economy. Does this sound like somebody who's worried about the housing bubble, who's warning about a housing bubble or a financial crisis or a great recession? No. Janet Yellen is just as clueless as everybody else. In fact, she admitted as much herself. In 2010, when she was testifying before the Financial Crisis Inquiry Commission, of course, I wanted to testify before that commission. They wouldn't let me, but Yellen testified. Now, let me read exactly what Janet Yellen said during that Financial Crisis Inquiry Commission. I quote, "I did not see and did not appreciate what the risks were with securitization, the credit ratings agencies, the shadow banking system, the structured investment vehicles. I didn't see any of that coming until it happened." Well, at least she was honest about it, which is more than we can say about the mainstream media, which is now trying to make her into something she was not. In fact, what's really ironic is you've got these same reporters who refuse to give me any credit whatsoever for actually having done what they're pretending that Janet Yellen did. But despite the fact that there's not only no evidence to support the claim that Yellen predicted the housing bubble or the financial crisis, and even though she's denied it herself, they're still going with that story and repeating it as if it were the truth. Now, what I want to do for the rest of this video, first of all, I am going to link to an article that I wrote in 2005, less than a month after Janet Yellen's "there's no housing bubble, nothing to worry about" speech at Haas in San Francisco. I wrote it less than a month after she made that speech. Read that article. It's quite comprehensive. It's one of many I wrote in 2005, by the way. They're all up on the archives in the Europac.net website if you want to read them all. But that's what a warning looks like. I didn't mince my words when I wrote that piece. I said there is a massive housing bubble, the biggest one ever. I went over all the evidence of that bubble, not just one little thing, rents, but I went over a long list of why it was a bubble, the biggest bubble ever. And then I went out to explain why there was a bubble, what the factors were that created the bubble. And then I warned about exactly what was going to happen to the financial system and the economy when that huge bubble inevitably burst. And you know, not only did I publish that article on my website, I sent it out to dozens of other websites that also published it, and I emailed it personally to over 100 reporters. Many of the same reporters who are now crediting Janet Yellen for predicting the crisis and warning about the housing bubble. I sent them these articles, and they never acknowledged it and never gave me any credit for any of the work that I did. So go back and read that. Also, what I've done is I put together a compilation of some of my appearances on television in 2006. Again, a year where Janet Yellen was saying the economy was in great shape, growth was going to continue, house prices are going to keep on appreciating, there's nothing to worry about. I was on television warning about all the things that she was so sanguine about. Now, apparently Janet Yellen didn't see any of these television appearances that I had, or if she did, she dismissed my warnings just the way everybody else did. But watch these clips, and then I'm finishing with some highlights from my 2006 mortgage banker speech, which was the second time I addressed the National Convention of Mortgage Bankers out in Las Vegas. I was there in 2005 with pretty much the same message. And many of the things that I said in 05 came true, which is why they brought me back in 06. And I repeated my warnings extensively. It's over an hour presentation, and I get into all the problems in the economy, and I focus on the housing market because I'm speaking in front of 3,000 mortgage bankers. So I'm tailoring my message to housing and the looming financial crisis and Great Recession. That is what it looks like when somebody is warning about a housing bubble, sounding the alarm, right? Trying to get people to listen. That's what I was doing. Janet Yellen wasn't doing that at all. Janet Yellen was part of the problem. She was at the Fed. She was oblivious to the bubble that the Fed inflated with its cheap monetary policies, and to expect that the Fed is going to be any different under Yellen than it was under her predecessors is wrong. In fact, the only difference is that she may make the same mistakes, only on a bigger scale, because I don't think Janet Yellen has any free market roots. I don't think there was ever a time where she believed in sound money like maybe Alan Greenspan did. I think she is a Keynesian, an inflationist through and through, deep down in her bones. I think that she will dig in and she will resist changing course. She will never admit to the monetary mistakes of the Fed. She will continue to repeat those mistakes until we ultimately overdose on stimulus. So rather than celebrating the fact that Janet Yellen is now chairing the Federal Reserve, we should be preparing for the collapse, because she will do nothing to alter our fate. If anything, she simply will ensure that when that collapse comes, it's that much more damaging, that much more painful a process to endure than had the president potentially nominated somebody with a better understanding of economics and monetary policy and how monetary policy affects the economy. So watch the following videos, read my 2005 article, and then do me a favor, share this with your friends. Let's get this video out there. I know the people that regularly watch my video blog, you guys know my record on the housing market, but most people don't. Most people have no idea that anybody was warning about the housing crisis before it happened. They're going to believe the mainstream media. They're going to believe that Janet Yellen was the voice of reason, that she was the one sounding the alarm. Right? That's not true. And we need to make sure that the truth gets out there. And the best way to do that is to spread this video, because the mainstream media is never going to bring out the truth. We have to bring the truth out ourselves and use the tool of the internet to accomplish that. In the end, the only person who's going to be happy that Janet Yellen is the new Fed chair is going to be Ben Bernanke. And that's because he's now off the hook. He's not going to have to go down in history as the worst Fed chairman ever. That's all for now. Bye, and thanks for your help.
The market isn't reacting negatively enough to the housing data, which is only going to get worse. You know, we're not just going to have a hard landing. We're going to have a crash landing. You know, all the inventory that's on the market is going to continue to build, and eventually prices are going to collapse beneath the weight of all that inventory. And then you fast forward a few months or next year, and a lot of homeowners who took out adjustable rate mortgages, negative AM mortgages, interest only, as their rates start to reset and they have to struggle to make those higher mortgage payments, they're going to have very little incentive to do so when their house is worth a lot less than the mortgage they're trying to service. And so that's when you start to see the defaults, the credit contraction, and the price declines really kick into high gear. And then, of course, you know, when you see consumers who have to spend every last drop of money on their mortgage payment, that means they have very little money left to go to Home Depot or to go to, Walmart. So consumer spending falls off the edge of a cliff, and, you know, there goes employment and the economy with it. So it's going to be a self-perpetuating spiral where the housing market and the economy both go down together.
Well, the number of people who have adjustable rate mortgages, according to the Federal Reserve, is actually quite small in proportion to the number of mortgages outstanding. Plus,
no, it's probably about 20. It's probably about 25–30%. And I think more importantly, if you look among the subprime market, and then if you look at the very expensive markets like California, you have a much higher percentage of adjustable rate mortgages. I think if you took a look at the total dollar value of all the mortgage debt, you'd find that adjustable rate mortgages represent a very high percentage.
Except they don't all adjust at once. They adjust over 1 to 7 years. So why is you so worried about what's happening in the short term? By 7 years from now, the economy will look a lot different, no doubt.
It'll probably be a lot worse. But, you know, as they start to adjust, that's a lot of people with a lot of mortgages. That's a lot of real estate going into foreclosure. You know, people cannot pay these mortgage payments. In fact, a lot of people bought homes with mortgages that they knew they couldn't make. Basically, they figured they would bail themselves out with the appreciation. When the appreciation is not there, they have no way of making these payments.
Okay. Joining us now, Peter Schiff, president of Euro-Pacific Capital. You know, there's lots of optimism about the housing market in 2007. Many experts have called the bottom. But, Peter, you say interest rates going higher at 07 means what to home prices?
Well, anyone calling the bottom in the housing market, including Alan Greenspan, it's just wishful thinking.
You know, the economy is stronger than everyone thought it would be. The U.S. economy is not going to go off a cliff. The Fed might be able to slow the housing market down, but I think home prices are going to be a big time next year. So I disagree 100% with
in fact, the U.S. economy is not strong. All we're doing is borrowing money from abroad.
Hold on. We're not going to get into that now. All right. What do you think about this link between rates and housing, Gary B?
Is there a gap, Gary?
Is there a gap there?
No, I'll tell you what, Brenda, I don't think there is a link between the rates and housing. We've seen, it depends on what you're talking about. If you're talking about new home sales, existing home sales, I'm talking about median home prices. It's like a freight train. They just keep going up. They went up through the 70s. They went up through the 80s. The only thing that derails the housing market, Brenda, is high unemployment. We don't have that right now.
We don't have it yet.
As far as Peter's talking about, yeah, I've heard this, people aren't saving, and yet, as we discussed on the first segment, household net worth, median net worth is at an all-time high, inflation adjusted, so I don't know where that comes from.
That net worth is all these phony inflated housing prices. Once housing prices start to come back down, the net worth is gone, but all the mortgages are still there.
Tobin?
You know, Peter, this is very good for selling newsletters, and I happen to be in the newsletter business, so we should talk after the show. But this is bunk for two reasons. Number one, as we all said, if you said, geez, American country doesn't save enough money, 80s, 90s, 80s, 70s, you can say it anytime. 1880. Yeah. We are a country that imports excess capital because other countries are bad users of capital. We're the best users of capital. That's why
we're not using capital. We're destroying it. All we're doing is consuming.
Peter, just start selling the dried food.
Okay.
Would you? Come on.
Scott.
Of course there's a link between interest rates and housing. But if rates go up, it could slow housing. It won't kill it. Housing is bumping along the bottom. It is bottoming. That's the key. But interest rates are remarkably low historically and remarkably stable. And my guess is that they will be for the next several years.
You guys sound like the people who were calling for the bottom in the NASDAQ when it was at 4,000.
Hey, Peter.
Yeah.
You want to come back on the show?
Homes be worth more or less in 2007. Time to get more for your money. Ben Stein, Patricia Powell and Mike Norman are back, and joining us now, Tom Adkins and Peter Schiff. Tom, what do you think?
You're going to see prices go up about 10%. Here's why. Because you're going to come into a regular, normal market, and in regular, normal markets, that's about what kind of appreciation you get. Why? I look at the hit that the housing industry took over the past year. You had oil prices that went up, which meant gasoline cost 50% more. You had the Federal Reserve over 2 years raise rates 300%. And still, the housing market barely took it at all. It became a 3% cut in prices.
So your judgment is home prices up 10% in the coming year. Peter, what do you say?
Well, today's home prices are completely unsustainable. They were bid up to these artificial heights by a combination of temporarily low adjustable rate mortgage payments, by a complete, absence of any lending standards, and by speculative buying. And what's going to happen in 2007 is a lot of these artificially low ARM payments are going to be reset upward. You're going to start to see both the government and the lenders reimposing lending standards and tightening up on credit. And you're going to see a lot of the speculative buyers turn into sellers. And these sky-high real estate prices are going to come crashing back down to earth.
Mike?
First of all, I have no idea what Peter Schiff is talking about. I agree with Tom. I think they're going to be probably up to about 10%. What artificial lending standard are you talking about?
Well,
mortgages have been issued. We have a tiny default rate in the single digits, and that only applies to subprime. In other words, people with the lowest level of credit standard. By the way, the economy still is very strong. We have a 4.5% unemployment rate. GDP is growing. The demographics, in other words, family formations, all the things that factor into housing are playing in here, and that is why we have not had a crash.
What I'm talking about, people buying houses with no documentation of their income, putting nothing down,
what percent
let me finish.
Let me finish.
With no documentation, putting nothing down, getting negative amortization, interest-only mortgages. They're buying homes they can't afford. They're speculating on appreciation.
Hold on. Interest-only mortgages there's nothing wrong with them because you're paying the interest, you're not losing money on it. But the key thing to look at is net income growth. If net income growth is going up and interest rates are staying the same, and we have no inflation right now, there's no reason for it to go up. You're going to see prices go up again.
Yeah, a lot of people who did that made a lot of money on their return on investment. They made a lot of money.
Wait. Last word to Peter.
Most of the profits that people have in real estate are going to vanish, just like the profits in the dot-coms in 1999, 2000. It's a fantasy. People can't sell their house. The inventories are exploding all over the country. Houses are on the market for 6 months a year. There's no bidders. The prices are going to fall through the floor. You guys are deluding yourself.
We heard it.
Think otherwise.
65% of the subprime mortgage market, 65% of those bonds, of those mortgages where a guy stated income, no doc, negative AM, risky loans, 65% of those things are repackaged by Wall Street and rated AAA. AAA.
the equivalent of sovereign debt of the best credit quality governments in the world. How can it possibly be that 65% of the subprime mortgages that are issued get a rating at AAA? How can that be? Well, the reason is Wall Street creates these tranches of CMOs, $1 billion worth of mortgages. And the way they structure it is they insulate the top 65% from losses by saying all the losses from interest and principal are going to go to these riskier tranches. The riskiest tranche, which represents 1% of the market, 10 million face, that risky tranche gets all the losses first. So that tranche has to be wiped out before any other tranche loses one dime of interest, let alone principal. Now, that particular piece of paper is rated BBB- and yields about 7.75% right now. That piece of paper should be rated F, and it will go to 0, as will several other tranches above it. Right now, one of the big trades that is starting on Wall Street, and which I'm participating in, is shorting that tranche. A lot of the brokerage firms now are creating derivative instruments where you can do these credit default swaps, and you can bet on those things defaulting. Now, what's going to happen as more and more people put this trade on, the price of those bonds is going to start to fall. As the price of those bonds, those risky tranche bonds, falls, the yields are going to shoot up. When that happens, it's going to make it impossible for Wall Street to collateralize this debt because it's going to be too expensive. Rates are going to rise, and the bottom is going to drop out of the subprime market. And of course, the subprime market is at the margin determining home prices. It's these buyers who are lying about their income, who are overstretching themselves, who are coming in here, and it's been made possible through this credit market where the buyers of these instruments are somehow believing they're insulated from losses, and people were willing to buy these risky tranches. Once they don't want to buy those tranches anymore, you're going to start to see a big drop or a big rise in interest rates, and that whole market is going to shut down. Because all of a sudden, when the mortgage people who are buying these bonds from you guys, when they can't resell them because Goldman Sachs and Morgan Stanley won't buy them anymore because they can't sell them, then it's over. There's no more market. There's no more secondary market for these products. So as expensive as real estate got, right, that's how cheap it's going to get. People are going to be completely amazed at the prices that houses are going to be selling for in a few years. Amazed. Just as amazed as the people were when they saw their shares of stocks go from 200 to nothing or practically nothing. It's the same thing. It's the same dynamic because you're going to have lots of sellers, you're going to have very little buyers, you're going to have a lot of foreclosures, you're going to have a lot of developers going bankrupt, you're going to have a lot of speculators. You know, I know lots of people own 5, 6, 7, 8 houses. You know, maybe they've had negative cash flow on these houses. Their negative cash flow is going to get bigger because a lot of them are refinanced with adjustable rate mortgages. You know, I know people who own many houses, and when they qualified on their loans, they wrote owner-occupied. I mean, there are people that have 7 or 8 or 9 owner-occupied homes in different states. I mean, everybody is looking the other way at these speculators buying houses. But, you know, they're all going to come on the market. Look where we are here in Las Vegas. I mean, there are so many condominiums that have been built in this town that nobody lives in. Their lights are never on. I mean, they weren't even bought with the intention of living in them. Some of them are so small, it's like nobody would even want to live. Why would you even want to buy a condo in this town? Look at all the hotel rooms. And they're pretty reasonably priced. Why would you want to own a condo? Well, the only reason people wanted to buy condos was because they thought they can flip them to somebody else. But as this huge supply of houses comes back on the market from speculators who got caught, and a lot of people who are speculators are homeowners. Just because you own your home and live in it doesn't mean you're not a speculator. If you bought a house using an adjustable rate mortgage, knowing that you can't afford to make the payments when they reset, you're a speculator. If you bought a house planning on selling it in 2 or 3 or 4 years, you're a speculator. That's all you are. So we had rampant speculation in this housing market, much more so than we had in the stock market. But the bigger problem is how intertwined the economy and the housing market are. You should put the houses on the market, and if you could find someone dumb enough to buy it and someone dumb enough to finance the transactions, you should sell. The fact of the matter is, the economy hasn't been humming. All we've been doing is going on a consumption binge, just like the heroin addict. These numbers are false. All they're measuring is how much wealth we're dissipating, not how much we're producing. We're borrowing money from the Japanese and the Chinese to buy the products that they produced on credit. We're going to go through a painful correction. Anybody that thinks that we're going to go from such a wide, out of whack imbalance, and all of a sudden we're just going to turn a little switch and it's going to be like a little, not a big deal, is fooling themselves. It's, just like when people told me, when I said the NASDAQ's going to drop 80 to 90%, of course I was right. Oh, no, it's only going to go down 10% or 15%. No way. We are way out of balance. We're not going to have a little mild recession. This is a major economic contraction that's coming, and the real estate market and the mortgage market is right in the forefront.
All right.
Janet is renowned for her good judgment. She sounded the alarm early about the housing bubble, about excesses in the financial sector, and about the risks of a major recession.
The Peter Schiff Show.